Hi folks, Scott here, and this is the wrap for Friday, June 28th. So today we closed down by a little bit, but we were still down. Actually down, well, not that much, but it was a down day, even though it looked like we were going to have an up day for a good portion of the day. But I want to show you right now the results of fading gaps after, or let me say it differently, fading gaps on the first trading day of a month after closing down on the last trading day of the month. So after a lower close on the last trading day of the month, what happens on the first trading day of the month historically when it comes to trading the gap? So I'm going to go to Gap Trader, my back testing tool, show you the strategy performance results. So we've had about 40 of these scenarios over the past 10 years or so, and the first thing that should pop right out to you is that the odds of gapping up are way higher than the odds of gapping down after a down close on the first trading day of the month. And a gap up is only a 50-50 play using an end of the day stop, meaning historically less than 50% of all up gaps have filled on the first trading day of the month after closing down on the last trading day of the month. So you've probably heard people talk about beginning of month bullish biases. Well, this is exactly what we're talking about here, both in terms of odds of where we're likely to gap and in terms of odds of gap fill. Gap down, you can't really read too much into that, even though gaps down on the first trading day of the month historically off the top of my head have been a little bit difficult for trading. So if you're not bullish enough to gap up, that doesn't mean by definition, well, that doesn't mean you should buy it as a buying opportunity because the day is going to be bullish. I think the fact that it gaps down on Monday could be seen as a weak sign, and we could have some volatility, if not another down close. All right, let's take a look at what the guides showed us going into today. And first thing I'm going to do, show you our worksheet. This is a summation of an average of the 8 individual indices gap guides. And today we opened, oh darn, I forgot and updated this already. Darn it, darn it, darn it. Sorry about that. Was multitasking and updated this while I was doing something else. Well, I can tell you what it showed you. It showed a 40 or 41% win rate if gapping down below the lows. It was a weak number and a weak profit factor. It just wasn't anything attractive there. And there were the data here showed risk for fading a down gap on the last trading day of the month. And down here, this was completely full. We had all kinds of patterns in play. The slight majority of them showed more risk than positive for buying a down gap. So as I showed in my, I'm sorry I spazzed and updated this before I did the video. I'll try not to do that again. But this is what I wrote in my pre-market comments around 9:20 a.m. Eastern time this morning. I start writing it at 9:10, by the way. I don't finish until 9:20, 9:23 normally. For last night's wrap, we did have one big positive pattern in play for down gaps, and that was the fact that we'd rallied 2% over the past 3 days, and without finishing at a 20-day high close, had made it a really strong pattern. But all those other patterns are just too weak. And that's what I said here. Gap guys are neutral to weak. Mixed but mostly negative factors for down gaps, so a gap down does not show a clear historical edge for fading, so no trade for me. I did make a note there are many cross currents in play, but the last trading of the month has shown above average odds of being a weak parentheses down day historically. That was just a reminder that it's a unique day and it has a pretty compelling had pretty compelling odds of something like historically 8 out of the past 31 last trade days of the month have closed down. So pretty compelling data. I've showed it in the trading room many times and discussed in other videos. I just want to remind people of that. And it was an interesting day. So markets sold off from the get-go all the way down to 1594. You would have been stopped out using our MTG stop parameters, which I think showed a 6.5 point stop. Today would have been the stop I would have probably used, and that would have been stopped out. So great decision, but actually wasn't a great decision. It was an easy decision to not fade today's gaps. It then reversed really hard because what it did, it filled that blue line there. That was yesterday's unfilled up gap. So it filled that, turning the white line gray or brown there, and then it rallied. The market internals were pretty weak, and knowing the end of day bias was weak as well, and having data that supported the market likely going sideways and down into the rest of the day, I went ahead and shorted a level. I can't remember what it was. It was a pure discretionary trade, and because nothing in the 15-minute range guides looked attractive to me or attractive enough. And I got run over and stopped out and lost 4.5 points. That was a small discretionary trade, not nearly a position size to do anything else. All was not lost, though. I'd put it just above the highs of the day. I told folks that is also telling us the fact that what is normally a decent setup, discretionary setup, when that didn't work, that showed me how bullish this market was, which gave me information that I used to not take the first hour range trades because they did favor the high fade. I'll show you that quickly. They leaned that way, sort of a toss-up, not quite strong enough for me. Some people did take it, I believe, and I'll get to the results in a moment. Look at the high fade here. So check. I'm looking for 55 at 1.1. It was right at it. Check. Right at it. Check. Neutral and check. 3 of the 4 futures favored it, but the ETFs were the problem. Though the spider was another check, a 4th check mark. Close there on the diamonds. We'll call it check 5, but not in the Qs and not in the Russell. So 5 of the 8 favored it. But I had concerns, as I mentioned, with the fact that the market already bounced really hard. Market internals were improving very quickly. There's bullish momentum in play from the 3 unfilled up gaps. So we know, that's an unusual scenario. And there was a third point I'm forgetting what that was. Oh, we were so close to gap fill. We were only 2 points from gap fill. When you get within 2 or 3 points of gap fill, you tend to see a vacuum of sellers. They'll lift their bids in a scenario like this, thinking, hey, I'll just wait till you fill the gap, then short. So I told people I thought the better play for the first hour fade was just to delay entry and fade around the prior day's close. That way you could use a smaller stop, 4 points, because the stop today, I think it was 1611 had you took. In fact, let's look at it. 1604, you would have gone short at 1603.75. Again, I did not do this. Some people did. Some people trade this data strictly mechanically. 6.5 point stop. Put it at 1610.25, and the high of the day was 1609.75. So, anyhow, my point, you would have survived actually and got filled on that last 5-minute bar of the day. How about that? Right in the cash close. I was looking because that was only looking for 4.25, 4.5 points. You would have taken some heat and it would have taken a lot of discipline to stick with it, but that's the way we play the game here. But some people did tell me that, so I know some people did that. Others faded the fill, and I told people I like to fade the fill because internals were favorable. It met my 3 criteria: confluence around gap fill, and I didn't fade the gap. Unfortunately, I was out a good portion of the day, so I could not trade it. And anyhow, some people reported getting filled at the end of the day. Now, I came back to trade the end of the day bias. One of the optimizations we ran showed what happens in the last hour of the first trading day of the last trading day of the month, and it shows a clear sell-off bias regardless of what the market's doing. As long as you gap down, you ought to be looking towards the south side. So with that in mind, I told people I would play this like a gotcha, and that's exactly what I did. I even drew a trend line in a trading room, something sort of like that. And I went short, actually, just above gap fill. Support and resistance doesn't matter when these things start getting momentum. I went short at 1607.25. And because I'd been stopped out, it's sort of been a choppy week for me. Yesterday was tough. Yesterday or the day before, I can't remember. I went ahead and I used a 2-point stop, locked in profits at plus 2.5, and I held the last half till 1601 and got filled right at the cash close. And really, in retrospect, I should have tightened my stops and let the market take me out to the upside, which is what some members did. One gentleman even reported getting filled just a tick above the low, 2 ticks above the low, for a 10-plus point win. So, sweet way to end the day. Easy, just using probabilities. Good stuff. And one note, folks, I got disconnected from the trading room, which booted everybody out of the trading room this afternoon around 3. So, most people, it looked like, got back in before this trade was executed. But again, my apologies. I think we rectified the issue. I've rectified the issue, so we should be good to go on Monday. Y'all have a good one, and that is the wrap for Friday, June 28th.